Hey y'all, welcome back. Today in this lecture we're going to talk about the second half of chapter 13, and that is we're going to talk about the second half of the cost of capital for the firm, which is the cost of debt. So we've been talking about the weighted average cost of capital, and in the first part of this chapter we talked about the term from the weighted average cost of capital that covers the cost of equity. Right? In this second part we'll talk about the second term. And this is just the most common formulation of the weighted average cost of capital. The most common sources of capital are equity and debt. But there could be any number of other potential sources of capital here that we could include. The most common other kind of financing is preferred equity. So we could have a third term here for preferred shares. But there's lots of new and interesting financing methods coming along. One of the ones that you may have heard about in the news is initial coin offerings. So companies are selling Bitcoin-like products as a way to raise financing for the firm, and then in return providing a tradable security that acts in a lot of ways like a stock, only it doesn't provide any ownership in the firm, but it does have intrinsic value in the sense that with the rest of the coin products in the market. Okay, so the weighted average cost of capital formula here, even though we're just looking at two terms, it can handle any number of terms, and it should. It should have a term here for every source of financing that the firm employs when it is making investments. But to keep things tractable, we're just going to talk about the two major ones because almost every firm is going to have debt and equity. Okay? All the other more unique and esoteric kinds of financing are not going to be held by every firm, so you can come across those and talk about how to value those securities and estimate their relative costs as the need arises. So what we're going to do today is focus on this first part in the WACC formula here. That is the cost of debt times the relative proportion of debt financing that the firm uses in its capital makeup. Okay, so that means we need to do two things. So the first part of the term says D divided by V, which is the market value of the firm's debt divided by the market value of the firm. All right. So the first thing we need to do then is estimate the market value of the firm's debt. And this is going to be straightforward, just like with equity. You just figure out how much debt exists and then you value it, add it all together. For a lot of firms, most of their debt, when we're talking about interest-bearing debt here, most of their debt is going to be in the form of corporate bonds. And so we just figure out how many bonds there are outstanding, and we multiply them times the price. Just like with equity, you figure out how many shares there are, multiply it by the price. With debt, it's a little more complex, only because there are more types of debt. So there are more sources where we have to go investigate, and more things that we have to value, and more things that we have to watch out for. With equity, we're just talking common equity here. So there might be, at most, a handful of equity issues. But with debt, there could be, and you can see like in the biggest firms like General Electric, there might be 30 outstanding debt issues. So there's a little more work, there's a little more complication, but the logic is still the same. Find out how much debt we have, estimate the price, add it all together. That's the market value of the firm's debt. Now it's important here, particularly with debt, that we are careful to only look at the market value of debt and not the book value of debt. Right? We need the price of a firm's debt does not necessarily reflect how much they borrowed. Okay? So we'll talk about what that means and how that looks. But this is perhaps more important on the debt side than on the equity side, because we've probably all heard over and over again that the book value of equity has nothing to do with them, or not nothing, isn't the same as the market value of equity. And that's true on the debt side too. So we just want to make sure that we're really careful about that. So step one, value the market, estimate the market value of the firm's debt. Right? That's one half, in our simple example, that's one half of the firm's capital structure, debt and equity. So once we have the market value of debt and the market value of equity, we add those two together to get V, the total market value of the firm. Step two then, we need to estimate the cost of debt. And the cost of debt is a very specific term, but in this case, the cost of debt is typically going to be an easier thing to estimate than the cost of equity. Right? So one side, the valuing the debt, is maybe a little more complicated. On the other side, estimating the cost of debt is a little more straightforward. And that's because the cost of debt itself is a little more straightforward. The cost of debt is just the interest payments that the firm has to make on its debt. And that's it. And those are all written down in contracts. Okay? Now, a little bit, there's a little more complex there. Maybe I should maybe I'm being a little too grandiose here, but there's a little more complex than that, because we have to go one step further. It's not just that we look at the interest payments that the firm is making and we say, okay, that's the firm's cost of debt. Because that's not quite what the cost of debt, what the idea of the cost of capital is trying to get at. The idea of the cost of capital is, what would it cost the firm to raise new financing now? Right? That's why when we estimate the cost of equity, we use as an estimate the expected return on the firm's equity. And here, the important part, the thing I want to put emphasis on is the expected part. Right? I don't want to look at the historical return on equity. I want to look at what the market expects for the future, because we're using this as an estimate of the firm's future cost of capital, because this is what we're going to discount the firm's future cash flows using. Right? The weighted average cost of capital, this is our discount rate. So we want a forward-looking measure, and that means we have to go one step further when we talk about the cost of debt. We effectively need an expected cost of debt, an expected interest payment for the future, much like we had the expected return on equity. So I can look at the historical interest rates that the firm was paying, but that's not enough, because the firm may face a different interest rate now if it tried to issue new debt. Right? Things may have changed. Depending on how long ago the firm issued debt, things may have changed drastically. Right? I mean, imagine the case that a firm issued a bond in December of last year. Right? So really topical. December of last year, interest rates were really low for corporate bonds. The economy was chugging along. Everything was going great. The firm, depending on the firm, but a healthy, financially stable firm probably enjoyed some of the lowest interest rates they've ever had if they were issuing debt last year. If they need to issue new debt now, they're going to face some of the highest rates they've ever paid, probably. Right? So things can change. And when we think about the cost of capital, we need to think about the future, not the past. Okay? So estimating the cost of debt is estimating the future interest payment on a bond that hasn't been issued yet, but might potentially be issued right now. And actually, that's not as hard as it sounds. This idea, the future cost of debt, is something called the yield to maturity, right? Or is estimated by something called the yield to maturity. And hopefully that rings a bell. Hopefully that rings a bell from your intro class, and from your investments class, and from your every class in between. The yield to maturity is something that is calculated on a day-by-day basis for the firm's already existing debt. It essentially stands in for this idea of, if a firm was going to issue new debt, what would the effective interest rate, what would an investor charge the firm now, right? And that is going to play into that comes about because it plays into the idea of whether an investor would buy a firm's already existing bonds. Right? Remember, bonds trade just like stocks. So there's a marketplace for bonds. And when somebody buys a bond originally from the company, they can sell it in the open marketplace later on if they no longer want to be a bondholder for the firm, if they want to take their money out and go do some other investment with it. What we have to think about when we're thinking about that marketplace is what entices another investor to buy an already existing bond for this company, because they can't change the terms of the bond, right? The terms of the bond are set in stone, so they can't change the terms. So what is going to entice them to buy the bond? Well, they're going to have to think about what they would currently charge a company to make a loan to them. And they're going to have to figure out a way to incorporate that into the price that they're willing to pay for this already existing loan. Okay, so luckily we can calculate yield to maturities using a calculator. We've got formulas to do with this. There's a couple of things that are going to make that a little bit harder. So there's some edge cases where we're going to talk about different ways to approximate the yield to maturity for the firm. But that's where we're going today. The last thing we'll talk about, but we've already really talked about what this is we need to multiply the cost of debt times the 1 minus the tax rate. And that's because what we're actually after here, or maybe that's too strong. What we're interested in here is incorporating the value of paying interest. And there is a significant value to paying interest. And it's because the IRS allows firms to treat interest as a business expense like any other business cost. And what that means is they're allowed to deduct interest from revenue before we calculate the tax bill for the firm. Right? Think about your income statement. EBIT minus interest gives us taxable income. That's where we calculate our taxes. So the higher interest payment we have, the lower taxable income we have, and the lower tax bill we'll have. And remember that when we calculated NOPLAT, when we rearranged the financial statements to estimate NOPLAT, we did not include interest expense. We didn't include any financing expenses, in fact. And that's because we didn't want to complicate NOPLAT, which is supposed to be an operating measure, with this idea of the interest tax shield and the financing benefit of financing with debt or equity, right? So we want to keep those two things separate. But we don't want to ignore it either, because the interest tax shield is a really valuable thing. Because we can treat interest as a business expense, it makes raising debt cheaper than raising equity. The cost of debt will always be cheaper than the cost of equity because of this tax benefit. Okay, not always, mostly. Although it'd be really weird if it wasn't. But anyway, I digress. Okay? So where we incorporate that, we don't ignore it. Where we incorporate it is here in the weighted average cost of capital. I want the after-tax cost of debt here. And so I multiply the cost of debt times 1 minus the tax rate. That's how we build in this significant value of the interest tax shield into our valuation process itself.